All right. Good afternoon. Sorry that we could not provide lunch here because this event is over-registered. We got over 300 people who registered for this event. This would be the largest number of registered participants for our events in recent years. I'm Weijian Shan, by the way. I'm the director of the Asia Global Institute. Since the beginning of this year, we started organizing in-person events, and I'm glad to see your real face without your mask on. And this is the first maskless event with audience and obviously the speakers finally feel free to take off their mask. And I thank you to take the efforts to walk up the hill and pass through all the obstacles. I think this is a good problem to have for the president of Hong Kong University, and our provost is here because there's so many constructions going on. And we are literally running out of parking space because the university is expanding really quickly with new faculty hired by different departments of the university. But apologize for those of you who had to take the time to come up to this part of the campus. All right, obviously you know why you're here because we have a very distinguished speaker today to talk about his new book, which is called The Money Machine. And you may have heard of his first book recently published called The Hour of Gobi. I'm going to talk about both of them later on. And by the way, you see books that are placed on the table outside. Mr. Shan is happy to sign a copy for you, and he's going to stay behind for around 15, 20 minutes to sign books that you purchase. But my job as a moderator is to first introduce Shan, and then I would get the privilege to ask the first few questions before turning you to ask yours. I will make sure that you have your chance to ask a question. I will give half an hour for Q&A. And the whole session is going to be very interactive. No PowerPoint slides besides this a bit embarrassing big hat of me hang up over there. So Shan. No. Shan. So Shan is his last name. We all call him Shan, but his first name is actually Weijian. If you bought any of his books, you realize that he would spend 2 pages trying to explain, why we Chinese would sometimes be called with the last name first and then followed by the first name. And, wonderful service that Shan has provided to educate the rest of the world about how to call Chinese, but he preferred to be called Shan. He's the chairman and CEO of PAG, a leading Asia-focused private equity firm, one of the most important. And I just checked on Google. You may update us on the new number, but asset under management is $50 billion US. Prior to PAG, he was a partner of another private equity firm called TPG and co-managing partner of TPG Asia, formerly known as Newbridge Capital. So Newbridge Capital is going to be, the main character of this book, Money Machine, which we are going to discuss later. For 2 decades, Shan has led a number of landmark transactions that have returned billions of dollars to the investors, including the main story today that we're going to discuss, and that is the Shenzhen Development Bank, which Shan helped Newbridge Capital to acquire in 2004 after 30 months of negotiation and ups and downs. Wonderful story, by the way. I read this book in 3 hours last night, and I couldn't fall asleep because of the excitement that I got. It really read like a fiction, by the way. Before joining the private equity world, Shan was actually managing director of JP Morgan in Hong Kong. He came to Hong Kong in 93, and he was an academic. He was a professor at Wharton Business School of University of Pennsylvania. I have to ask you why you abandoned academia and joined the investment bank. Maybe it's too late for me to ask this question, but you managed to make a lot of money after that.
Money was not good enough.
But anyhow, Shan, who grew up in China, went through the Cultural Revolution, and that's really the background of this book, Hour of Gobi. And he went to the United States to get a Master of Business Administration from University of San Francisco. I heard there's a story about why you chose U of San Francisco, which we're going to get into later. And he got a PhD in economics from UC Berkeley. So let me jump directly to talk about this book, Money Machine. And this book was written, how long did you take to write this book? It really read like a fiction, very well written. And I trust that you really have a degree in English.
I did, but in China, in Beijing, without a degree. I did study English when I left the Gobi, went back to Beijing in 1975. When I was in the Gobi, I read the dictionary, but when I came back to Beijing, I learned how to actually speak English. But that was it. I studied English for 3 years before I went to America.
That's a wonderful story. So let me just ask a very simple question and let you elaborate on the details of the book. Why did you choose to write this book? What did you expect us, the readers, to get from the book? I know the book is about a very important acquisition. You know, when you were a partner of New Bridge Capital, you helped your company to acquire a very important bank, Shenzhen Development Bank. It's a national bank, it's not a local bank. And at that time, it was the first foreign firm gaining control over a Chinese national bank. This made history. But what you're trying to tell us from telling this story about the acquisition?
Well, thank you very much, Hei for that, very kind introduction. You say that you're going to ask me about the details of the book. I would prefer that the audience reads the book, so I'm not going to disclose too much of the plot. But the reason that I wrote this book is because I thought that there should be a book of this kind. You see, I'm in private equity business. The so-called private equity business is to take money from institutional investors, such as state pension funds. If Hong Kong University has endowment, I'm sure you do. What do you do with that money? You need that money to produce money for the university, and typically the university endowment would give money to private equity investors to manage the money for them. So we manage money for state pension funds, for university endowments, for family offices of rich people, I'm sorry to say, and for sovereign wealth funds all over the world. So this is what we do. And private equity has become a very big industry worldwide. It really started in late 1980s. If some people may know this, but in 1988, a firm by name of KKR acquired a major food company called RJR Nabisco. And two reporters wrote a book about that particular transaction called Barbarians at the Gate. And the transaction took place in 1988. The book was published in 1989, just about how these people were able to outcompete others to acquire the control of this company for a cool sum of $25 billion, which at that time was considered to be a big amount of money. Today, it's no longer considered a big deal, but at that time, it was the biggest ever corporate acquisition in the United States. Now, today, the private equity industry has become very large. There are twice as many firms controlled by private equity investors in the United States as publicly listed companies in the United States. That's how large the private equity is. And so private equity makes big difference to the economy, to the market, and in the financial industry. And yet, there was no book talking about how private equity actually makes money, to tell a story of a private equity transaction from beginning to the end, from making the investment to exiting from the investment, and what happened in between. You see, Barbarians at the Gate was written only 1 year after the transaction took place. But after KKR made that investment, they stayed in that investment for 15 years. Honestly, they didn't make money, but that story was only about deal-making part, Barbarians at the Gate, of that transaction, not the full story. Henry Kravis is one of the KKRs. Kravis is one of the K. He likes to say that any idiot can buy a business. It is what happens to the business that really matters. Because if you pay more than everybody else, obviously you will be able to buy a business. We talked about this issue over lunch. But how do you make money out of your investment? And some people lose money, some people make money. So it is more interesting to know what happens afterwards, and eventually whether you made money or lost money. And my book, Money Machine, a trailblazing American venture in China, is such a story. It fills a void, it tells the whole story of a private equity transaction from beginning to the end, and how we made the investment, how we turned around that particular institution, how we grew it, and how we eventually exited, and what the result is. I'm not going to tell you, but if we were not successful, I wouldn't have written a book. So that's the hint. That's why I wrote the book.
So I still have very clear memory about the events that you described. But one thing that I could not hold myself from asking is, there was a very special period, right? So you started the negotiation with different parties in China in 2002, and the deal was finally closed in 2004. In your description about the negotiations, the meetings with different people, there are some famous names that I myself, with very limited knowledge about China, would be able to recognize. So my question for you is, in retrospect, it was a very successful acquisition, but you were working in an American company with American partners. Do you get full support from your team? And whether you would be concerned that this is a very risky business, it's the first national bank in China acquired by a foreign company, you are actually not so certain about the outcome, or you already have full confidence because you talked to, you had a chance to meet great leaders like Jiang Zemin and Zhu Rongji, and you knew that this is the beginning of a long, high growth period for China.
No, I was not that confident. Nobody could be so confident. The reason we were approached at all to buy this national bank, there were a number of them. First, the bank was very troubled. It was, for all practical purposes, insolvent. It's called Shenzhen Development Bank, SDP. Located in Shenzhen, but it was national, with branches all over the country, several hundred branches, thousands of employees. When we closed the deal in 2004, on December 30th, 2004, the nominal capital ratio of the bank was 2.3%. The regulatory requirement for banks in China worldwide was 8%, so it was way below the regulatory required capital ratio. But that ratio of theirs, I emphasize nominal, because the actual was negative, because they lost so much money, they had so many bad loans. If they had fully provisioned for the bad loans, their capital ratio would have been negative. And it was a time when the entire China's banking system was in trouble and technically insolvent for the entire China. Why? In 2002, PBOC, People's Bank of China, which is the central bank, estimated that the bad loan ratio, non-performing loans, bad loans are loans which are not performing, meaning the borrowers are not able to pay the money back. So the bad loan ratio in the entire China's banking system in 2002 was estimated by the central bank as representing about 30% of their entire loan book. 30%. Now, I just mentioned that the regulatory requirement for capital ratio is 8%. So if you have 30% bad loan ratio, that means your embedded loss is much greater than the capital of the bank. And that means the entire banking system is technically insolvent. Standard & Poor's is the international rating agency. they check to see the credit worthiness of a company, also known as S&P. S&P published a report in 2002. They estimated that the bad loan amount, not the ratio, the amount, ratio is 30%, in the Chinese banking system was about $500 billion. US dollars, $500 billion. Just to put that number into perspective, the GDP of China in 2002 was $1.1 trillion. So they say that the Chinese banking system had bad loans representing about 50% of China's GDP. Today, China's GDP is about $18 trillion, but at that time it was about $1 trillion, 50% of GDP. So S&P suggested that in order for Chinese banks to reduce the bad loan ratio from 30% to 5%, it would take at least 10 years, and maybe as many as 20 years. And this was 2002. Think about it. By the estimate of S&P, if things went well, we would still have come to about 5% of bad loan ratio today, 20 years later. And that was how bad the situation was, how dire the situation was. And in fact, a number of people told me that nobody in his right mind would buy a troubled bank in China. So it was not at all obvious that we should buy a bank. That's number one. Number two, why were we approached in the first place? Because we had done something as foolish before. In 1997, there was Asian financial crisis. And some people have lived through it. Other people are too young to perhaps even know about it. In 1997, Asian financial crisis happened on July 2nd with the devaluation of Thai baht, the currency. And then it quickly spread to all parts of Asia, including Hong Kong. And in Hong Kong, on October 23rd, 1997, Hang Seng Index dropped 16% in one day. Think about it. It's frightening thought, right? 16% in one day. And that was almost the peak of the financial crisis in 1997. And banks were shaken. But look at Korea. Korea was even in a tougher situation. In 1997, the stock market of Korea dropped 49% in 1 year. But that's not the full story. The exchange rate of Korean won against the US dollar dropped 65.9%. So in US dollar terms, Korean stock market dropped 85% in 1 year. So much wealth was wiped out. About 150 banks failed in Korea. The foreign exchange reserves of Korea at the end of 1997 dwindled down to about $8.9 billion. Korea was and is the 10th largest economy in the world, an OECD country. It still is the 10th largest economy in the world. It was the 10th largest economy in the world. But for Korea, its foreign exchange reserves came down to $8.9 billion US dollars, enough to last the country about 3 days at the rate of capital flight at that time. To put things into perspective, my firm, as Hiwai mentioned, today manages 50 billion US dollars. Korea, as the 10th largest economy in the world, had only 8.9 billion US dollars left. That was how dire the situation was. So Korean government appealed to Korean citizens to sell their jewelry, their gold, to help the central bank replenish its foreign exchange reserves. That was how terrible the situation was. So it was at that time IMF, International Monetary Fund, and the World Bank went to Korea and provided the country with a rescue package of $58 billion, largest ever in history for multilateral institutions by that time, $58 billion, to save Korea from going bankrupt, it will become obvious why I talk about Korea. It'll come back to China very soon. And with the condition that the Korean government can take this money, $58 billion, but you have to sell at least one of the banks to foreign investors. Why? Because international organizations believed that Korea banking system got into trouble because Korea didn't have a credit culture. Credit culture means that you make loans based on the ability of the borrower to pay the money back. If you make loans without regard to the borrower's ability to pay the money back, and that kind of culture would be not a credit culture. Credit culture is to look at the credit worthiness of the borrower. So how did Korea do banking? If they didn't have a credit culture, if they didn't care about the ability of the borrower to return the money? Well, banking was done in Korea before the financial crisis of 1997, mostly on the basis of relations. I know you, my father knows you, and so on and so forth, personal relations, or on the basis of industrial policy. So if the government supports the shipping industry, banks will give money to shipping industry, or textile industry, not on the basis for credit. That's why Korea didn't have a credit culture. That's why so many banks failed, including what used to be the largest bank in Korea, called Korea First Bank. It was failed. It was nationalized by the government in 1997. And my second book, Money Games, deals with our acquisition of control of Korea First Bank in Korea during that period of time. Now, because we bought a failed bank in a failed economy in the middle of a financial crisis, and then we turned it around, made it profitable, it got a lot of notice, especially in Asian markets, banking markets in Asia. And that gives the idea of whoever wanted to sell Shenzhen Development Bank to come to us, because we were considered to be turnaround specialists, turnaround artists. So if we could do our magic in Korea, and possibly we could do it in China. And it was at that time the Chinese government, led by Zhu Rongji, whose boss, of course, was Jiang Zemin, also began banking reforms in China. And Chinese banks had similar problems as Korean banks, making loans on the basis of relationship and industrial policy, but not so much on credit worthiness of the borrower. So we were viewed as somebody with the experience, with the knowledge to turn around very troubled banks. So Chinese banks were in dire situation. Shenzhen Development Bank was very troubled, even worse than some of the better run banks in the country. And there was need for banking reform, and we happen to have some experience as known in the market to turn around very bad banks. And that's why all these things together, somebody came to me on April the 1st, 2002, came to my office. It was a very hot day, as I described in the book, and asked this question: are you interested to buy control of a Chinese bank? And that's how we started this journey. But I was not quite sure. I said I would like to look into it.
So Shang, I think you really like challenges, because after the success in Korea, you must know that China in 2002 is still very different from Korea. And in the book, you did describe all these ups and downs due to changes in the leadership, in the local government, in the central government. And they also started to bring in a Taiwanese potential investor to compete with you. So I guess all these were unexpected. And in the end, you didn't give up, right? After 30 months of negotiations, dealing with different parties, and even trying to get to the international arbitration court, why did you not give up? Is it in your DNA that you have to finish this, or you truly believe that if this deal is completed, it will be a hallmark deal for you, for your company, and there will be a lot of wealth coming in?
Well, we were in the bind at that particular point. On one hand, it was an opportunity we were still checking out. We didn't know that if the risk was too high. A lot of people thought we were foolish to attempt to buy control of a very troubled bank in China. On the other hand, I thought that it was a very rare opportunity. In any country, to buy control of a bank is exceedingly difficult. In the United States, you just can't do it. The United States has a Bank Holding Company Act of 1956, which does not allow a non-bank financial institution to control a bank. And control is defined as owning more than 25% of the shares. So it's very strict. Look at the United States. No bank is controlled by a non-bank financial institution. The same is true elsewhere in the world. For example, in Korea today, a financial investor cannot buy more than 10% of a bank, the shares of a bank. Basically, non-financial institutions anywhere in the world are not allowed to buy control of a bank, developed world at least. And in China, banking regulation was just being put into place. And the Chinese regulation says no foreign investor can own more than 20% of a Chinese bank singularly. Collectively, no more than 25% of a Chinese bank. Several foreign investors get together, they can't own more than 25%. Single investor, no more than 20%. And the financial investor has to be qualified, meaning you have to be a financial institution. We were not, right? So the barrier to entry is extremely high. Now, why do you want to get into banking system in a country like China anyway, even if you are allowed to do so? We were given this special right just to take a look. And we thought it's a rare opportunity to just take a look. If we can underwrite it, this will be a very rare opportunity. But Chinese banking at the time was very special. In Hong Kong, for example, how does a bank make money? You make money by making the interest rate differential between the lending rate and the rate that you pay to depositors. You pay, let's say, 5%. I know they don't pay 5% for your deposits. Let's say they pay 3% for your deposits, and they make loans at 4% interest rate. Their interest margin is 1%. But of course, there's operating costs you will have to deduct. The net interest margin is very thin. If they can get 1%, you're very, very lucky. And there's a lot of competition. If HSBC will lend you at 5%, and Bank of China Hong Kong lend you at 5.5%, of course you go to Bank of China. So because of the competition, the spread, that is the interest rate differential, we call spread, is very thin. 1% or sometimes even less than 1%. In China at the time, the central bank controlled the lending rate and the deposit rate in such a way that the spread is about 3.5% to 4%. A very fat spread, fatter than anywhere in the world. And this is what I call a license to print money, because regardless of the competition among the banks, that spread is guaranteed by the central bank. You can't deviate from it. You can't lend for an interest rate less than the benchmark interest rate set by the central bank. You can't take deposits for interest rate higher than what's set by the central bank. So your spread is guaranteed. And this is what I call a license to print money. And that's why I entitled this book as Money Machine. But there is a catch. What is catch? The catch is if you throw money away by making bad loans, you make loans but you can't recollect the loans, then whatever spread doesn't mean anything. It doesn't matter, right? You just give money away. And that was the problem of the banking system in China. We were very worried about all the bad loans in Shenzhen Development Bank. But at the same time, because of our experiences in Korea, we knew we had the knowledge and experience and international best practices to set up risk management systems so that the new loans that we make will not become bad, and therefore we'll be able to capture that very fast spread, which I call printing machine, to make money and eventually use that to offset the losses embedded in the asset book of the bank. Whether or not we would be able to do it, I didn't know until in fact, even when we closed the deal, there were some doubts in our mind whether or not we'll be able to do it. That is, if the hole was too big to be filled, or we would be able to fill it, and how long it would take us to do so. So we were of the two minds. If they don't allow us to do this deal after we have started this process, we feel very sad. If they allow us to do this deal, we feel very scared. So either way, we didn't feel so well.
So in short, you love challenges. Let me ask the last question on my side and turn to the Q&A. So the first chairman and CEO of the acquired Shenzhen Development Bank is a guy called Frank Neiman, right? Frank Neiman is a white American. I just cannot foresee how meetings in the meeting room can be conducted, with a white American head with a bunch of Chinese on the board. So how did you manage to get this guy to be the CEO, or the environment was so different back then compared to today that maybe the Chinese government actually loved to have some foreigner to head the bank?
In fact, Frank Newman, who was Deputy Treasury Secretary of the United States in Clinton administration, the Treasury Secretary was Lloyd Bentsen. He was Deputy Treasury Secretary. And after he retired from government, he was Chairman CEO of Bankers Trust. And eventually, we hired him to be Chairman CEO of Shenzhen Development Bank. But he was not the first CEO we appointed for that bank. We appointed another American to be the head of that bank when we first took over the bank. And when we appointed the first CEO, he is very well credentialed. He has worked for international banks, a number of international banks, for many years, and he speaks, writes, and reads Chinese fluently. And he's white American, and yet he is very steeped in Chinese culture and in Chinese literature. He taught in Beijing University as well. But he was not experienced in running a bad bank. Our bank was bad. He was trained in all the good institutions, but not, I don't think he had ever seen a bank as broken as it was. So it's not automatic for somebody who knows how to run a good bank to run a bad bank, and there are a lot of changes that we needed to be made. So when I went to the chairman of CBRC, China Banking Regulatory Commission, to suggest that we need to bring in somebody who knows how to run a bad bank, he was very alarmed. He said, Weijian, since the founding of the People's Republic of China, we have never allowed a foreign investor to take over control of a Chinese bank, nationwide bank. And this was a publicly listed bank as well, with a ticker number of 000001. It was the first company ever to be listed on Shenzhen Stock Exchange. So it was a very big deal for a foreign investor to buy control of nationwide bank. We knew it was approved by the Prime Minister himself, actually by two Prime Ministers, by Zhu Rongji first and by Wen Jiabao second, because the deal lasted for a long time. And then there was a change of government. And then, for the first time since 1949, we ever approved for a foreigner to be the CEO of a bank. And now you want to replace him. That's too big a deal. So I said, Mr. Liu, there's a risk that our bank may go bankrupt. You can't allow that to happen. That would be too devastating. Unless, I said, we bring in somebody who can change this bank, to transform this bank because it's so broken. Somebody who knows how to manage a bad bank. And he said, well, you have to make sure that this bank is safe. And he allowed us to do so. So Frank Newman was the second banker, CEO of the bank. But he doesn't speak a word of Chinese at that time. He still doesn't speak much Chinese. We figured that it was more important to bring in somebody who knows banking. And we knew Frank Newman very well because at Korea First Bank, we invited him to be a board member. So we worked with him for a number of years already, 5 years already. So he was known factor to us. And therefore, there's no risk that we would replace him. And we thought it was much more important for him to know banking and know how to turn around a bad bank than to know Chinese. So to make up for his shortcoming of not speaking Chinese, we just equipped him with a couple of translators. It worked out okay. In Korea, we hired a French banker to be the president of the bank. And we equipped him with a French translator, French-Korean translator, and an English-Korean translator. So banking is more important than being able to speak the language. And my partner, David Vonderman, who was the founder of TPG and chairman of Newbridge Capital eventually changed its name to TPG Asia. But, he was very much involved in the deal. He said there's one advantage that Frank doesn't speak Chinese. And I said, what's that? He said, nobody would ask him for favors.
I think that was a rational world, right? The next question is going to be whether you think is possible today, right? To have a Korean bank headed by an American, to have a Chinese national bank headed by an American. The world has changed. I guess I'm getting into
it's just a matter of circumstances. Circumstances change, special circumstances arise. So what may be perceived as impossible under certain circumstances would become possible under some other circumstances. The world always changes. People ask me whether or not some of our exploits could be repeated today, as if we made money in the past, so we couldn't make money in the future. I think there are always good opportunities. It's just you don't know what kind of circumstances will give rise to what kind of opportunities.
I love this answer.
But I'm convinced there will be opportunities.
I really love your answer. This is a very diplomatic and optimistic one. Let me open up to questions from the floor. And I'm sure there are a lot of your fans who want to know more. Well, there are 3 hands here. How about lady first? 2 ladies, and then we turn to the 2 gentlemen.
Thank you so much. Thank you so much, Heaven, for sharing this event, hosting it. And thanks so much, Mr. Shan, for sharing your knowledge and insights. I have a few questions. I'll try to limit it. First is, I read your bio.
Please, one question at a time. Otherwise,
Okay. I read. Okay, I will adjust it.
And your name, please?
I'm Sally. Nice to meet you.
Sally, yeah.
Yes. I actually read one of your interviews. You were saying there's a different strategy, like investing between China and India, right? Like India is more export-oriented, and while in China there's like private consumption. I was wondering, do you see any trends or any things that's happening in this space that could be what we can look for in private equity industry? Thank you.
Thank you. That's a very good question, although it has nothing to do with the book. Actually, I like to talk about things not related to the book. Yes, our strategy for investing in China is very different from our strategy for investing in India. Very different. As private equity investors, we first look at the macroeconomic conditions, look at the market, and then we look at the businesses that we're going to invest. So if, for example, a country is going into an economic crisis, no matter how good the business is, is going to suffer. And therefore, you have to understand macroeconomic conditions. For years, we made a decision not to invest in China's export sector. I would say in the past 20 years, we have followed the policy of not investing in China's export sector. Why? If you look at the Chinese export sector, the costs of input, labor, and currency have been rising over the years. In the past 10 years, Chinese labor costs probably has been rising at about 10% per year, double digit. No other country has experienced such rapid increase in labor costs. And currency has been rising in the past 20 years against the US dollar. So the costs of input have been rising for the export sector. And China has a big problem. It goes back to how China has developed in the past 40 years. China developed so fast because China has invested so much. China has been investing fixed asset investments about 45% of GDP. Year after year after year after year, 45% of GDP. To put this into perspective, no other country at any time in history, at any stage in their industrialization process, has invested even close to 35% of GDP. Look at the United States after the war. Look at Japan after the war. Look at Korea after the Korean War. They have not invested even close to 35% of GDP. But China has been investing 45%, sometimes even close to 50% of GDP. Why? Because China has a lot of money. That may not be very obvious. China has the highest savings rate in the world. Today it's about 45%, but for years it has been hovering about 50%. In macroeconomics, savings translate into investments. China just has so much money to invest. China is actually a country of capital glut. I read the news coming out of the United States to say that America may restrict investments into China, and I think it's almost silly because China has a lot of capital. In fact, the Chinese government is probably the largest creditor of the U.S. government by holding $1 trillion of American treasury bills, treasury bonds, right? So because China has invested so much, China has created a problem called overcapacity. So there's overcapacity in almost every major industrial sector that you can think of. China produces, for example, more than half of all the steel in the world, more than half of all the cement in the world. Actually, China used 30% more cement in 3 years than the United States did in 100 years, in the entire 20th century. And that's how much capacity that China built up. But because of capacity, you see a phenomenon that a growing industry is not profitable because there's too much competition, there's too much overcapacity, right? I used to show my investors a chart to show that between 1992 to 20 years later, China's GDP grew in nominal terms 24 times. In 20 years, China's GDP grew 24 times. If you had invested in the stock market in 1992 and held your investment, never sold, 20 years later, how much money do you think that you would have made when the economy grew more than 20 times? You would lose 50% of your capital. Why is that the case? Growth doesn't translate into profitability. Overcapacity depresses profitability. Because of overcapacity, the prices of finished products don't increase. So until very recently, the world has enjoyed many decades of deflation, low inflation rate. How come? even though there's QE, there's money printing in all developed countries, negative interest rate and all that, flood the money into the market. Why there's deflation or very low inflation until 2021? What happened in 2021? There was some bottleneck in supply chains from China that triggered off this round of inflation. So because China was exporting inflation to all over the world, deflation to all over the world. So if you're in export business, your costs have been rising and your finished products will now enjoy higher prices, so your profit margin is squeezed thinner and thinner. And that's why we stay away from the export sector, even though that sector has been growing very rapidly. Last year, U.S.-China trade has reached the all-time high, about $700 billion US. Now, in India, our strategy is the opposite. Why it is the opposite? Because rupee historically has been rather weak. And there's a risk of devaluation, sometimes massive devaluation, 10% a year. At one time, even 20% a year. And rupee is very difficult to hedge because the rupee interest rate was, for a long time, so much higher than US dollar interest rate. Hedging cost is a function of interest rate differentials between the two currencies. So if you invest, so in China, we invest in businesses which cater to domestic demand, but not exports. And if in India, you invest in businesses which cater to the domestic demand, then if there's devaluation, you lose 10% or even 20% of your capital, and it's not hedgeable. So in India, we invest in businesses which do outsourcing, like Infosys, they are drug companies. They sell their products, their services to foreign markets, and then they receive US dollars, euro, Japanese yen, hard currency. And their cost is in rupee. If there's devaluation, they're better off, right? So our strategy in India is completely the opposite of our strategy in China. But I'm getting too much into investments. Thank you for that question.
That's very interesting. Two questions, maybe the lady first. Please state your name and your affiliation.
Sure. Hi, my name is Sandy. I'm a Hong Kong U alumni. I first like to thank you for writing a book about deals in this part of the world. I feel like we do a lot of great deals in Asia, and we don't write about it enough. We don't talk about them enough. I do want to ask you questions about your book. And by the way, I went to your book talks previously, and you just get better over time, and thank you so much. So first, I want to ask about how you address the misalignment of incentive of the loan origination team or relationship manager of a bank. As you know, you said that Asia doesn't really have a credit culture, and you make it sound like it's a very easy thing to just create credit culture within a bank, just make better loans, then you can turn it around. But one of the problems of the subprime mortgage in the U.S. is that the relationship managers or the loan origination teams, they only make money when they make loans. So they just keep making loans no matter, the credit worthiness of the borrower. So I wonder how you address that moving forward with Shenzhen Development Bank. And on the related question is...
could you please just ask one question so that
it's
other people...
It's related, but okay.
Okay, yeah. So, and maybe you can ask a follow-up.
Thank you, Sandy, for that question. It's actually very simple. We eventually did at Shenzhen Development Bank, actually we very quickly did it, is to separate relationship manager from credit decisions. So you are relationship manager, you deal with customers, and customers would make a loan application and they want to get a loan, but you don't make the decision. You gather all the information and then you send the information to the credit officer who doesn't report to you. So we set up a system that there is a credit committee in the head office. And the credit committee has many credit officers in the branches reporting directly to the credit committee, not to the branch manager. The branch manager is the relationship person. but he has no authority over the credit officer. So you separate this relationship, and the relationship manager would get many applications as possible. And then the credit committee will make a decision whether or not a credit is extended. Let's say a credit manager gets 100 applications a day, and then only 2 were approved by the credit officer or credit committee. Then that means the manager is not doing a very good job. He gets all these low-quality applications, so he would see his salary cut or his bonus cut as consequence, right? And if you separate the relationship from credit decision-making, then you avoid that particular problem to give wrong incentives. Because for the credit manager or credit officer, his only incentive is to have good quality loans. And if his loan goes bad, it's his responsibility. So that's how we solve that problem. Yeah, we better.
Shan, thank you very much, for your comments. And
I'm very surprised you are here to challenge me.
And I've enjoyed reading all the books, all 3 of them, and I would recommend them highly. I know you well, and I know that you are sort of viewed as, an expert on the banking systems throughout Asia. One quick question is, 20 years on, a lot of people are asking questions about the health of the Chinese banking system. I'd be curious to get your views on that, what opportunities you think could come out of that, and whether a private equity firm with U.S. global investors would be allowed to participate in those opportunities. Private equity opportunities coming out of the dislocation in the banking system. I mean, the NPLs are back, right? So if you can comment on, the state of the banking system today in China, and whether you see opportunities coming out of that.
I will say something that you don't read in the mainstream media, especially Western media. In 2008, the so-called global financial crisis happened with the bankruptcy of Lehman Brothers. It's called global financial crisis because it happened in the United States, when in fact it didn't really affect Asia that much at all. In 2008, many banks failed in the United States. Lehman failed, AIG got into trouble, all of them. Goldman Sachs had to raise capital from Warren Buffett and all that. Of course, many European banks failed, RBS and the like. But none of the Asian banks failed, none of them, even though it was so-called global financial crisis. So somebody told me it shouldn't be called the global financial crisis, it should be called the Atlantic financial crisis, because it didn't really affect Asia. And look at the Chinese banks. And Chinese banks were very healthy in 2008. And that's when some Chinese bankers started to doubt all these best practices that they borrowed from American banks were really the best practices, right? And what happened was that 1997 Asian financial crisis taught a big lesson to all the Asian countries. Look at Korea. It restructured its banking system. Japan sold a number of its failed banks to foreign investors. And Indonesia revamped its banking system. So by 2008, 10 years later from Asian financial crisis, Asian banks, by and large, were in very good health. And Hong Kong banks were in excellent health. None of the banks got into trouble. Now, today, people look at China, Chinese banking system. Of course, China just went through probably the roughest year in 30 years last year with regard to its economic performance, 3% last year. And you would expect that the bad loan amounts increase in Chinese banks, especially with the trouble with the real estate sector. By and large, I think the Chinese banking system is healthy. By and large, I don't think there's any systemic risk in the Chinese banking system. By and large, I don't think that China has a debt problem, as many Western commentators would tell you, and I will give you some numbers to back it up, okay? People talk about Chinese government debt, especially local government debt. How much is there Chinese government debt? Altogether, if you combine local government and central government debt together, it represents 76.8% of GDP. Now, the Japanese central government debt represents 2.63% of GDP. China's total debt is 76.8% of GDP. China's central government debt is 20.8% of GDP, just about 21% of GDP. Very small number. The U.S. government debt, federal government, represents 140% of GDP. So in comparison with other major economies, and China's debt level is exceedingly low, even if you include local government debt. But that's only half of the story. I know Li Ka-shing has borrowed more money than I have. Should I be worried about him? Should I be worried about him? I'm not worried about him because he has vastly more assets than I have, right? So he is not in a net debt positive position. You know, he has net capital, net assets. Just look at the other side of the balance sheet, that is the assets. The Chinese government owns SOEs, state-owned assets. The SOEs, state-owned enterprises, their net asset value of last year was about $13 trillion, just about the same amount of Chinese debt. Now, we know net asset value is underestimate of the true value. You know, look at the pharmaceutical company, his net asset value may be very little. 1 year profit may be larger than net asset value. So the true value is much larger. So if you as an investor, we look at net debt, that is your debt minus your asset. Look at the net debt position of the Chinese government, it's negative. SOE's net asset value is $13 trillion. Big banks in China add another $4 trillion net asset value to the Chinese government. And I don't include some other things. So China very enviably is in a negative net debt position. Among all the major economies, China is in a unique position. They're under-indebted. So the Chinese banks at this point, I think the bad loan ratio, the true ratio has increased, but it's not at an alarming level. Why? Because China has a special regulation that nobody else has in the world. That is, the regulators require that your bad loan coverage ratio is more than 150%. That is, if you have $1 bad loan, you have to set aside $0.50 of capital against it. And therefore, it's not worth it to hold a bad loan because you take too much capital. So there's very strong incentive just to write it off or to sell it off. So the 1.6% average bad loan ratio in the Chinese banking system is more or less correct. Some special mention loans may migrate into bad loans. Let's call it another 1%. Let's say 2.6%. I'm just making this up to be conservative. It's not a big deal because the average capital ratio is about 12%. So the Chinese banking system is very healthy, largely because the asset side of the balance sheet is there and no commentators will talk about it. They only look at the debt.
Sorry, we're a bit out of time. How about we take 2 more questions? One that has been raised earlier here and then one in the middle. And I guess I need to let my provost speak in the end.
Thank you, Mr. Shan. I'm Wang Ruihao from Haitong International. I'm a junior M&A banker. And I heard that in your previous interview with The Economist last year, 2022, you said in the long run, our economy, China economy, will go up. But in the short term, it will go down. In the midterm, it will go worse. And you're always preparing in your 10 years in the Shangsan Xiaxiang period. So how would we, as bankers, to prepare in this market downturn? And in the yesterday government working report, Li Keqiang Premier said that in the new year, we're going to stress on the consumption. Would you think the consumption will replace the downstream of the net export mentioned by this lady? Thank you.
Thank you very much for that question. I don't believe I said those words. But I can answer the question anyway. I think that my expectation is that the economy, Chinese economy, will do better this year than last year. It has to do better, because last year was so bad. And I think the Chinese economy is probably going to do better than the market consensus. The market consensus is about 5%. Because I think the long-term trend for the Chinese economic growth is still about 5% per year. But last year, it was 3%. So if you look at a 2-year average, there's another 2% to add to this year. And let's say 1% is probably better than the 5%. So I'm rather optimistic about this year's performance. Going forward, I'm not so certain because in the past 18 to 24 months, I think the confidence of consumers, businesses, entrepreneurs was badly shaken. In English, there's expression, once bitten, twice shy. How do you bring that confidence back? The confidence was shaken by policy issues, regulatory storm and all that. I think it will take some time for confidence to come back. The Chinese proverb is much more vivid. We say that once bitten by a snake, for 10 years you don't want to see a rope, and you're afraid of seeing a rope. So it will take time for confidence to return. I'm talking about the long term. So I think that as long as confidence comes back 50% this year, we should do quite okay. It will take at least a couple of years of policy stability for full confidence to come back. I don't think that China can win off from the growth model of relying on fixed asset investments anytime soon. The savings rate is still 45% of GDP. So I expect a lot of investments to be made this year to help with economic growth. But last year, something very remarkable happened. Deposits in the Chinese system by households went up $2.6 trillion. $2.6 trillion, that's huge. The total deposits is $18 trillion, the same as China's GDP. But the net increase, according to PBOC, the central bank, was $2.6 trillion. Why? People didn't have anywhere to spend the money, right? You can't go out for restaurants, and you're locked down and all that, so you put money into the bank. I think if 10-20% of that money is spent this year, then that's a lot of consumption. That would be a big help to the economy. And that's why I think, yes, consumption will come back. Probably it will not be the only driver of economic growth. I would expect exports to be softer this year. I would expect investments to continue, and I would expect the economy to do much better this year than last year. But over the long run, we depend on confidence to come back fully, and that's a function of policy stability, and we can only hope.
There's a gentleman here who wants to ask the last question, and then Richard can speak. Yeah, Shan, you will be on FT again tomorrow.
I don't think I'm saying anything controversial.
Yeah, dear Mr. Shan, your book wrote about American private equity firm acquiring control of a Chinese national bank, and the fact this happened means at that time the Sino-U.S. relationship is still good, but right now it is getting deteriorating. So my question is, what's your view about the future prospect of Sino-U.S. relationship and how it would impact Hong Kong's financial market, as it is a bridge between the U.S. and China? Thank you.
Thank you for that question. The U.S.-China relationship at this point is very bad, and I expect the relations to get even worse going forward. You just read the press every day, you will know that relationship is going to get worse. But I think there are two dimensions in this relationship. There's political dimension, there's also economic dimension. On the political side, as I mentioned, I expect it to get even worse. It's almost free fall, and you don't know where it will get. But on the economic side, despite of all the talk about decoupling, despite of all the trade war which started in 2018, U.S.-China trade reached all-time high last year to $700 billion US. So there is a break in political relationship and the economic relationship. And I think the interdependence between the two economies is such that it's very, very difficult to separate them out, even with the effort to decouple from China. Some manufacturing has relocated from China to Southeast Asian countries, very typically by Chinese owners. But that's because it's just cheaper to produce low-end products in Southeast Asian countries, for example. But for complicated manufacturing, sophisticated manufacturing, it is hard to move to anywhere without a similar supply chain around you. And that similar supply chain is also dependent on a sophisticated infrastructure, high-speed rail system, ports, bridges, airports, highways, and so forth, and the talents who would like to live nearby, right? So I think real decoupling will not happen in a substantial way anytime soon. And I hope, and besides, China is no longer just a factory of the world. You know, you make goods in China and then you export to the United States and other countries. And that role has come down substantially. Exports used to represent 36% of China's GDP about 10 years ago. Today it's only 18%. So China has become a market of the world. What do I mean by that? General Motors sells more cars in China than in the United States, Canada, and Mexico combined. Volkswagen sells more cars in China than the entire EU. So where do they go if they want to sell to the China market? They will have to make cars in China. Intel, 25% of its revenue comes from China. Apple, there are more iPhones in stock. There's larger stock of iPhones owned by individuals in China than in the United States. So because of all these reasons, the decoupling is not going to happen anytime soon, or ever, in my view. And therefore, I think the economic dimension of this relationship hopefully will serve as some kind of a break to the free fall of the political relationship.
But how about technology? I mean, people talk about technological decoupling.
Technology, yes. There's effort, of course. We all know about semiconductors, advanced semiconductors. Yesterday, or the day before yesterday, Australian Strategic Policy Institute published a study sponsored by the State Department of the United States. And the result is quite astounding. At least I was astounded. Of the 44 cutting-edge technology frontiers in the world that people have identified by this institute, China leads in 37. Check out this article. It's called Australia Strategic Policy Institute. Their new report just came out, their new study just came out, and the study was sponsored by the US State Department. So here and there, the technology embargo would have an impact. Semiconductor, advanced processes, there's no question about it. At this point, I think there's only one country which can contain China's growth, and that is China. If it makes policy blunders, the United States cannot.
Totally agree. Richard, do you want to ask the last question, or you give some closing remarks?
No closing remarks. Please. Thank you, Weijian, for a very wonderful talk on your topic, and also very enlightening Q&A. Every time I hear you speak, I learn a great deal. I'd like to go back to your talk, a trailblazing American venture in China. I'm sure buying the bank is a major exercise, and there are many different stakeholders in China. Why did they sell, and what do they hope to achieve, and was it achieved?
It was part of the banking reform. The bank was troubled, and it needed to be fixed. But China was not only doing that. You remember around the early 2000s, Zhu Rongji and Zhou Xiaochuan, who was the central banker, Liu Mingkang, who was the chairman of CBRC, they created 4 asset management companies corresponding to 4 largest state-owned banks, Bank of China, CCB, ICBC, and ABC. Each one of them created the AMC, Asset Management Company, which we would call bad bank, because its function is to carve out all the bad loans into the AMCs so that the bank would become cleaned up. They would not have bad loans. And after that, the regulators decided each of them had to invite some foreign investors into them, not for their capital necessarily, but for their best practices, for their skills, for their knowledge, for their experiences. So Bank of China, I think, brought in RBS, CCB brought in Bank of America, ICBC brought in Goldman Sachs. They all made a lot of money. And all these foreign investors benefited from investing in clean banks. At that time, 1 times book value was considered to be a steal. Today, it's too expensive to operate the bank. So in our case, we bought this bank without the government putting a penny into the bank. And the bad loan ratio, as of the end of 2004, was 11.4%. Reported, the actual was twice as bad. I already reported the nominal capital ratio, which was 2.3%. It was a very broken bank. The actual capital ratio was negative. So they wanted us to come in, based on our experiences in Korea, to turn around this bank as part of China's banking reform. We were not that high-minded. In retrospect, we played a role in the banking reform. But that was not our intention. We just wanted to turn around this bank, and so that our investment will be safe, we will make money out of it.
Thank you so much, Dr. Shan, for the wonderful discussion and Q&A, and please give a big round of applause to our guests. So, money machine, money games, out of Gobi are all up for sale outside, and I believe Shan can stay behind for 10 minutes to sign some of the copies that you're going to buy. Thank you so much.